Banking stocks suck when interest rates are low because low interest rates means generally banks make less money. But I think I may have found an exception. This stock that I'm going to discuss is a publicly traded digital bank that's going to revolutionize the way you and I bank today. If you think this video is helpful, please leave me a like and subscribe. So I'm not the only one who has thought about taking all banks online. Digital banks, or neobanks as they're commonly referred to, are actually taking the world by storm. In fact, according to this article here, which is a research piece by Grandview Research, the neobanking market is expected to reach $722 billion in market size by 2028. If you compare that to where it is today, that's equivalent to a compound annual growth rate of 47.7% during this period. Or in other words, the neobanking market is going to be expanding by 47.7% each year between 2021 and 2028. Now, according to this piece, the reason why the neobanking market is expanding so significantly is because of a demographic shift towards digitization coupled with escalating demand for digital apps. In other words, I think the neobanking market is being driven by people like me who value the convenience of digital banking. If we take a look at the US retail banking market today, what we find is that 50% of us hold bank accounts with the top 10 legacy banks. So these banks are incumbent banks such as JP Morgan, Chase, Wells Fargo. However, that doesn't mean that these banks are doing everything right. If you look further, you find that the same amount of people actually have more than one bank account. So if these banks were doing everything right, you'd expect people to have just one bank account, but clearly the incumbents are missing something. And so we find that the incumbents are missing something when we ask customers why they're opening multiple bank accounts. And the summary here is people own multiple bank accounts because there just isn't a bank that's offering them everything they want. Users cite the fact that their existing bank isn't as convenient as they would like it to be, or because it doesn't offer the right products or have the best fees, as reasons why they are having to open multiple bank accounts in order to get the things that they want. And so this is where SoFi comes in. SoFi is a neobank, and they're being taken public by Social Capital head of Sophia. So they currently trade under the ticker IPOE. The thing about SoFi is they see this problem. They see that customers are opening multiple bank accounts purely because there just isn't a single bank that does what customers want them to do. And SoFi's strategy is to be what they call a winner takes most in this market. So SoFi see the market for neobanking a bit like the market for e-commerce or for social networking or food delivery, in that they think there will be one player or one dominant player in the market, and the reason they're dominant is because they offer everything that consumers would want, and they keep consumers on their platform, which then ultimately means that player can innovate better than the rest of the competition. Now, SoFi's had to do a lot because they've only been around since January of 2019. And if we look at this slide on their investor deck, we see they've been very busy. SoFi's had to innovate very quickly and offer a substantial number of products in order to keep members on its platform. So what started as a simple money account, SoFi's had to go on to then add on investing accounts and home loans and credit cards. This strategy that SoFi are using is ultimately leading to more members staying on their platform because SoFi are offering them the products that they ultimately need from a bank. So we can see how effective this strategy of cross-selling or upselling is when we look at one of SoFi's examples. So SoFi show us that if they were to acquire a new customer for a money-only bank account, they would have a variable profit of $85. If they then went to acquire another customer for, say, a personal loan, they would see a variable profit of $938. So in total, on both of these products, SoFi has a profit of $1,023. Instead, if SoFi are able to sell the original customer that they acquired for a money-only account and then upsell them a personal loan, SoFi would see a profit of $1,848. This is higher than the last example. Why? Because SoFi doesn't have to pay an acquisition cost on the personal loan. They're just selling a personal loan to a customer they already have on their platform. Now that small difference leads to a very large difference in the bottom line. If we compare these two profit numbers, ultimately, SoFi are achieving almost an 80% improvement in their bottom line compared to if they had to acquire a fresh customer for each of these products. So upselling has a very, very big impact on SoFi's business. Now, this is not to mention the fact that when you're cross-selling products, you also get to choose which customers you're cross-selling products to. If I find out this person who has a money-only account has terrible credit history and is really bad at paying his bills on time, then I might not want to offer them a personal loan. I can be very selective. So is this strategy working for SoFi? Well, SoFi is reporting a rapid increase in the number of users on its platform since inception. However, at the same time, they're also expecting much higher increases in multi-product members. So the number of users on their platform who have more than one SoFi banking product. Now, if we drill down on this specific aspect even further, we find SoFi actually reports the proportion of cross-sells for each business segment. So for example, here we find SoFi is selling 22% of its total personal loans in Q4 of 2020 to existing customers. What this shows is that across all of these products, SoFi on average is cross-selling about 24%. So 24% of its total new accounts are coming from existing members. But also, some of the higher margin businesses, such as home loans, have much higher cross-selling percentages. So 69% of new home loans in Q4 of 2020 were actually sold to existing customers. All of this is ultimately feeding through to SoFi's bottom line. And if we look here, SoFi is expecting adjusted EBITDA to be positive in 2021. Now, the reason why this is remarkable is because most neobanks actually don't make money. They spend way too much money acquiring customers and trying to scale, and then ultimately it takes a lot of time for these banks to turn a profit. So it's fantastic to see that having just been started in late 2018, early 2019, SoFi's actually been able to, or will expect to turn an adjusted EBITDA profit in 2021, and then is expected to continue to increase well into 2025. The reason why SoFi is expecting to turn a profit so quickly is because they have a very strong underlying business. SoFi's business is split into three key business segments. The first is its lending practice, the second is its technology platform, and the third is its financial services. Starting with SoFi's lending platform, SoFi is 100% origination only for its loans. So unlike some other banks, SoFi doesn't buy outstanding debt obligations that other banks have. No, SoFi, when it gives you a loan, SoFi takes that loan and puts it onto its own balance sheet and then sells that loan to other banks or to third parties. That is where the highest margin form of lending lies. The second part of SoFi's business is its technology platform. Now, SoFi did acquire a company called Galileo for $1.2 billion in 2020. Galileo is a technology services company that allows neobanks to host banking software and to process transactions. The thing that's so clever about this transaction is SoFi can use Galileo to host its own banking infrastructure, but can also turn Galileo into an income-generating machine by outsourcing Galileo to other neobanks. In fact, Galileo is used by some of the largest neobanks operating today, such as Robinhood, Chime, and Moneyline. This is very clever because it's turned something that would otherwise be a cost center into something that actually generates money for the business, and those margins are a not too shabby 62%. The final part of SoFi's business is its financial services platform. Now this is currently the smallest part of SoFi's business, but it is expected to grow the most. And I think we can all start to understand why that's the case when you look at apps such as Robinhood and the craze around wanting to invest and be involved in cryptocurrency trading and stock trading. SoFi plans to build out its investment platform over the coming years, and as consumers potentially transition away from apps like Robinhood due to reputational issues, I think SoFi is going to be a key winner in this segment. Ultimately, SoFi's goal is to turn what is currently a very lending-heavy business into something which is kind of more evenly spread across those three business platforms in 2025. Should you buy SoFi at today's valuation? Now, the way I would answer this is to look at two key metrics. The first is a price to sales based on SoFi's projected sales into 2025, and then ultimately a price to earnings ratio for that same time period. Now, IPOE, the special purpose acquisition vehicle which is taking SoFi public, had a market cap of $2.31 billion as of the close of business on the 8th of February. Now, if we turn to SoFi's investor deck, we find that shareholders of IPOE will own a 9.3% stake in the whole SoFi business. So in order to determine what that means for SoFi's valuation, we take $2.31 billion, divide it by 9.3 and multiply it by 100%. This values SoFi's entire business at $24.84 billion. Now, if we look to see what SoFi is projecting as earnings in 2025, we find that they're expecting to have $3.7 billion in adjusted net revenues and approximately $635 million in net income. So let's run a quick calculation here. So take $24.84 billion, which is what we calculated SoFi's valuation to be, and divide that by 3.669 billion, which is their net revenues in 2025. This implies that today's IPOE price is reflecting a price to 2025 expected revenues of approximately 6.8 times. So you're buying a stock at a 6.8 times its 2025 projected sales. If we do the same for its net income, 24.84 divided by, this is in millions, so it's 0.635. This is a 39 times price to projected earnings in 2025. Now, buying a business at, call it a 7 times price to sales and a 40 times price to earnings, and those earnings and sales being 2025 numbers, is certainly not cheap. Don't think at the same time it's a super unreasonable valuation. And so there you have it. Banking is an industry that's prone to disruption, and I think SoFi is a winner takes most in this market. The reason I think that is because 1, they have a proven ability to cross-sell. 2, they have the best technology platform. And 3, they have very defendable margins in 2 out of 3 of their key business segments. The valuation is not cheap by any means, but given all the positive things on the horizon, I think this company is a good buy and hold for long-term investors. As always, let me know what you think by leaving me a comment in the comment section below. And if you thought this video was helpful, please leave me a like and subscribe so that you get to see my new content, and it also helps out my channel. Thanks.